4, 3, 2, 1.
Welcome, everybody. Welcome, everybody, to the ARMR Report. Back in the chair after being out for a week. And I'm, for the first time ever, doing a live YouTube stream to go along with our podcast. So you all can enjoy this any way you want. Now, the market's blowing out, making a new high right now as Fed Chairman Powell's about to speak. I thought I'd do the show and at the same time he's speaking. Because quite frankly, I don't care what he says. It's the reaction to the news, not the news, that matters to me. This is a show called the ARMR Report, Algorithmic Risk Management Research. And it's a show about stock market investing in the millennial age. What I like to say is, this is not your dad's stock market. It's not your granddad's. There's news coming at you from every angle, and you need tools to help you manage the risk first and then capture upside second. And the number one tool we use here is our algorithms. Algorithms that we've manufactured from years of doing this that help us manage the risk. Tell us when to put risk on and take risk off. So what we do is we take traditional fundamental analysis of companies and groups and themes, and we marry that with the millennial tool of algorithms and exchange traded funds and volatility quotients and manage the risk. This is a live trading desk, so I'm looking all around me. I've got screens all around me. And I'm managing my own personal assets as well as that of individuals. Everything we do, we run through interactive brokers. We have 3 separate accounts that anybody with an interactive broker account can link to. It's a conservative approach, a balanced approach, and an aggressive approach, all guided by algorithms. All right, so right now the market's blowing out above the high of the day. And apparently whatever Chairman Powell is saying, people like for right now. But beware, these things sometimes only last 15 or 20 minutes. So the real key is particularly big up bars. We're getting a big up bar right now. It's 12:03. I guess the transcript is out. No preset policy. All the things the market wants to hear is what Powell looks like he's going to be talking about. So the question is the reaction to the news. We know it's blowing out on the news. The question is, what does it do from here? So first thing I like to do, I've been off the desk for a while. You all can follow step by step what our algorithms are telling us on our website. It's rosenthalcapital.com. We have a real-time risk on, risk off monitor. And when something changes with the big 5 indexes, and I've made a change there too. I'm going to get to that in a minute. Those of you who've been watching, or I should say listening to our podcasts, know that we have algorithms designed for the S&P, the Dow, the NASDAQ 100, the small cap index, and the mid cap. And those 5 indexes guide all of our risk on or risk off behavior. I'm changing out, though, the mid cap. Mid cap and small cap tend to kind of go together. They kind of run almost in lockstep. So it's a little bit of a kind of a waste. What I want to do is focus on small cap like I always do. That's the most sensitive part of the market. The market starts going down. It starts in small caps. Those of you listening to this podcast for the last couple months know at the end of September, we were telling you to reduce risk because small caps were breaking down. And that was well before the quote, death cross in small caps. By the time the death crosses happened, everybody knows about it. The market's already down 15%. Doesn't really help you. You need algorithms that are more sensitive than that. If everybody knows something, such as death crosses, where the 50-day and the 200-day cross on a negative way, algorithms are designed to take advantage of people who know something that obvious. So you got to get ahead of the algorithms with your own algorithms, your own tools. And that's what we're doing here. So September 24th, we were selling all of our small and mid cap assets, which told investors of any kind, whether they were aggressive or conservative, it's time to start reducing exposure, reducing risk. Now, let's look at what the algorithms are telling us. We've been away for a week. Last time I spoke to you guys, I was telling you I was short the market. We were long puts on the S&P 500 and the triple Qs and the small cap index. We covered all those puts 2 days ago. Book profits. Yesterday, we had long risk on algorithmic signals on the triple Qs and the small cap index. Now, small caps tested their stop this morning, but now everything, of course, is rocketing higher because everyone likes what the Fed chairman's saying. This is probably the beginning of a rally to the end of the year. That's a guess. That's not an algorithmic statement. But if you follow us on Twitter at hashtag ARMR Report, I try to update you as soon as I can. Again, this is a live trading desk. You see me look off camera because I'm looking at trades that I actually have on right now or trades that I'm thinking of getting on. All right, rule number 27 I want to get to. But let's just, first go over the top 5 indexes again. Oh, by the way, I'm changing out that index. The mid cap I'm getting rid of. I'm not getting rid of it so much as it doesn't really add any extra edge to our investment strategy. And I'm replacing it with the momentum ETF. That's another Millennial tool we have here on our trading desk that we focus on, and that's exchange traded funds. They have a major impact on stocks that you own, and it's a great way to get exposure to different groups. So the momentum index, I find, is a very good ETF, MTUM. It's a leading indicator for the whole market. As its name suggests, it tries to focus on momentum stocks. And as once we get into an uptrend, you want to focus on the most momentum names. They outperform the market. And so those are the top 5 indexes now I use to determine how much risk I want in a portfolio. In a conservative portfolio, 20% of the portfolio is long the Qs and the small cap index, 10 and 10. 80% is still in treasury bills, which we've been holding for more than, I guess, almost 2 months now. Balanced approach, we've got those 2 indexes in the portfolio, but we also have some individual stocks in there. When the market's going down, like it's been going down for the last couple months, we're doing our homework, our research. We're putting things on the top of our whiteboard, stocks we want to own, groups we want to own. And then we use the algorithms to tell us when to take our shots. I can't share with you every stock that I buy here. If you really want to literally participate in everything we do, best to go to Interactive Brokers, open an account, and link it to Rosenthal Capital Management into either bucket that you want, the conservative, balanced, or aggressive, and you'll see everything we own. But I can share some things, like, for instance, Microsoft is in our account. To the top of our whiteboard, we always want to get a piece of Microsoft if it gives us the opportunity. It did. We're in that stock. Illumina is another company, another NASDAQ 100 name. So as you can see a pattern here, when we get a long opportunity in a group ETF, and let's be honest, QQQ is a group ETF. It's top 100 technology names. Microsoft, the top of that list. Illumina, top of that list. We're going to focus our buying in the group ETFs that we're also getting a risk on entry point for. So those are some of the things we own in the portfolio right now. And we go from like a 20% exposure conservative right now up into the close to 50% exposure coming into today in our aggressive portfolio. So right now, if we look at those 5 indexes, only 2 are telling us to get long. But today's day 3 of this perhaps change in trend. And that gets us to the rule number 27. For my podcast followers, this is new for my YouTube watchers today, but I'm building a list for you all of rules of the road. I've been doing this for more than 20 years. Wait a minute. 20? I've been doing it more than 30 years. I can't believe I've been doing it that long. But it's true. I've been managing money for 30 years now. Actually, this is the 30th year. And I've just got a lot of rules of the road from doing this for a long time. And I'm writing a book of knowledge that I'm giving to my children. I have a 5-year-old son and a 2-year-old daughter. When they're 18, I'm going to give them this black book of rules, dad's wisdom, if you will. And a section is going to be investing wisdom. And between now and then, I'm going to share it with you guys every day, 12 o'clock, podcasts, live streams. Then eventually I'll put up some blog posts for you to help you put them all together. But Rule 27 is an important rule in any downtrend, which is something we've clearly been in for the last couple months. A 2-day rally means nothing to me. 2 days, totally normal. And it could be a big rally. It could be a huge percent. Market could run up 3-4% in 2 days. It doesn't change the downtrend. Day 3, that's the day that matters. That's the day where we get follow-on, risk-on buy signals across the board, or we get a failure of the early signals. So in a conservative account, okay, I got 20% of the money to work because yesterday was just day 2, and I don't want to get overextended yet. But if the market blows out to new highs today, and I get confirmation from the S&P and the Dow and the momentum index, and all 5 of our most important indexes tell us it's risk on, that's when we hit the gas and we start adding risk across the board. So we're not going to know that yet. I mean, the market just blew out for the last, we're on the 12th minute now of a big run off of the 12 o'clock, Chairman Powell announcement. It's not even an announcement. He's just making some comments, rates to stay low, the basic stuff. The basic stuff that calms the market down, makes people, feel more comfortable. Hopefully, I hope this lasts, right? If the market can hold on to these gains the rest of the day, we're probably going to get, and I'm going to just go to my other computer here, and every now and then I'll do some screen captures for YouTube, for my YouTube stream, so you guys can see what I'm talking about. I'm not doing that today, but I'll do a specific and special video for you guys on YouTube where we capture the screen and you can literally see the algorithms working. But right now, you can't see this on the screen, but I'm looking at my algorithm for the S&P. And yeah, if the market closes anywhere in this area, we're going to have a risk-on entry for the S&P, which will confirm the early risk-on signals for the NASDAQ and the small caps. And it looks like, the Dow and the S&P will both be telling us to put risk on. If I move over to the momentum. So if the market can hold on to this today, I do think this is the beginning of the, quote, Santa Claus rally that takes us through the end of the year. I think the risk is in the market already. We all know there's a China trade problem. We all know that the Fed is raising rates. This is why it's been such an awful 2018. Awful being lots of volatility, no real direction, some big stocks getting destroyed. It's been a very difficult year. It's precisely because the Fed's raising rates. When the Fed reduces liquidity from the system, markets go down, markets get choppy. That's just the way it is. I know for the last, 3-4 years, even longer than that. There was that little window when Janet Yellen raised rates a little bit in 2015. The market, dropped 15% in 2 months at the beginning of 2016, and she immediately released, liquidity into the system, and we ran for the next couple of years. So this is really the first year in a while, let's put it that way, depending on how you want to look at it, 5 years, maybe a decade, probably the first time in a decade since the Fed's been reducing liquidity in an aggressive manner. And that makes for a very difficult year. So the question is, what happens next year? Now, we are going into the best time of the year for stocks. December, January, February is usually a good time of year. So I find it interesting that the market puts in a double bottom, over the last month or so. We get risk on signals yesterday, and we'll get confirmation today. We're going into the best time of year, and all the bad news is kind of in the market already. And this coincides with rule number 27, which is day 3 is what's really important when a trend is changing. Not day 1 or day 2, and not percentages. I mean, I don't care if the market's up huge in one day. It doesn't mean anything in a downtrend. It's just typical short covering hysteria. But if the market can hold on to these gains today, then I think we add to them probably the rest of the year. And I don't really care, what Donald Trump and the Chinese are doing. This market goes up and down based on what the Fed's doing. So if the market really believes that the Fed is not going to overstep, then you're going to get a market that can come off of these lows, come off of the double bottoms. This is a tough time, though, in the market. As I've said on other podcasts, when the 50-day and the 200-day moving average for the S&P are in downtrends, it's the most dangerous time in the market. It's why I got short. I mean, I got long the puts on the markets, which is short, over the last couple of weeks. And we booked a decent profit, nothing huge, made some money. But I haven't done that in a long time. I haven't been short in a long time. I generally don't short if the 200-day moving average is in an uptrend on the S&P. So there's a lot of cross currents, and you don't want to overthink it. And that's the whole point of the ARMR report and the whole way we run money. We use algorithms to tell us when to put on risk and when to take off the risk. Because there's always reasons to argue with market performance. It could go this way, it can go that way. I mean, I could spend the whole half an hour talking to you and arguing both sides of the equation, bull and bear. Particularly right now. I mean, there's so many cross currents. So what we've got to do is tamp down the noise, stop listening to all the different news sources and all the different scaremongering, and just look at the facts and the behavior of the market. I always try to say, and again, podcast listeners are used to this, but I'm going to say this as often as possible. This is the most important thing you could do when you put money to work in the equity market. Before you put it to work, ask yourself, am I on the right side of probability and statistics? And is the reward big enough for the risk being taken? That's the question. In fact, what rule is that? Yeah, rule number 3. Every investment decision that we make on the trading desk starts and ends with those 2 thoughts. If we boil everything down, we're having a risk on entry signal that may be confirmed today. So all 5 of our most important indexes are telling us to put risk on. We have a double bottom in place. All the bad news seems to be in the market. Don't tell me about Trump and all of his problems. We've known those problems. They keep getting worse. They're always going to get worse. That's what the news does. It makes you afraid. It works on your fear and your greed impulses. And what we're trying to do with algorithms is get rid of those fear and greed impulses and say, look, if the reward's big enough, which we know it is now, the market's been destroyed for the last couple months. Some big cap names, Apple, Amazon, Google, Facebook, all the Netflix, all these big winners in the past have been whacked. So a natural retracement would be a real nice trading opportunity for us, at the very least. I mean, does that evolve into the next bull, run that lasts 6 to 12 months? I don't know, maybe. We're never going to know that. Even though a lot of guys on CNBC like to postulate and tell you they do know that, they don't. They don't know what the market's going to do next. All we can do is put money to work when the reward's big enough. How do we do that? Well, we like to buy weakness. You say to me, the market's up today. How could you buy today? I'm not looking at today's action. The weakness of the last couple months, guys. Come on, catch up to me. It's the weakness of the last couple months. We put some capital to work yesterday. We add to it today if we get the close that we want and we get risk on across the board, and then we stop buying. That's the beauty of the strategy. We put risk on when the reward's big enough and we know where our stop is. The further we get away from this day and yesterday, which is really the risk on days, the more dangerous, because the stop becomes further and further away. So I'm willing to get out there and put risk to work yesterday and add to it today. I'm getting paid today, right? I covered my shorts 2 days ago. I put on risk yesterday. I add to it today, and then my portfolio's set, and we see how high this move can take us. And we use targeted exits. So we're buying low, and we're selling high, right? Seems simple. Everyone talks about buy low, sell high. You know why it's so hard to do? It's exactly contrary to human emotion. That's why. And so algorithms help deal with the dichotomy between emotions and the way you're supposed to really manage assets. Here's what happens to most people. They're afraid of the market. They don't put any money to work yesterday, even though the market's turning, telling us to put money to work. We have a great update today on volume, and they say, it's up too much. I'm going to wait for it to come down. So they don't put money on. The market runs 3-4 days in a row, 5 days in a row. Then they start throwing money at the market because they missed it, right? Ask yourself if this is you. You're afraid to put money to work yesterday and today, but you feel comfortable putting it to work a week from now when the market's already up 5% off the low. Does that make a lot of sense? 10% off the low. You start scrambling around looking for your ideas. Too late. Too late. Fear and greed are taking over. Fear that you're missing it. Greed that you're not making enough. It's not the way to run money. Get rid of your ego. I bought yesterday. I'm going to be adding more today. The whole thing craters tomorrow and I get stopped out. So be it. So be it. It's okay. Small amount of risk, big reward if we're right, and the thing runs for the next couple of months, which typically the market does during this time of year. So that's rule number 27. Okay. Got 7 minutes left in the show. Let's skip to some other things. A note of caution that kind of bothers me, and maybe this will change by the end of the day, but you know, the way we invest is kind of like, if you think of a pyramid, you know, we're building like this. Okay. So we start, our bottom layer is the big 5 indexes that I've mentioned. And then what we do is we add the next layer of group ETFs. So on the whiteboard, what are the groups we want to own? Groups like the cannabis stocks, groups like cybersecurity, big software companies, big data companies, the revolution in payments, right? So there's ETFs that like iPay that have things in them like Square and PayPal. So these are all of our favorite type of groups. If the bottom layer tells me to get long, which is the big indexes, that's step one. If I don't have that, I don't get long. So once I get that, I put money to work. But then depending on what the other 2 layers show me will depend on how aggressive I get, how much money I put to work. So right now, that second layer of group ETFs looks awful. I can't find any group ETFs I like. That's a problem. So that's probably going to temper my enthusiasm. I'm going to put money to work. But unless some of those groups really start to give us a risk on entry points to confirm what's going on with the big indexes, chances are I'll have less exposure this time around than on other risk on entry points. And then the third tier are individual stocks. So when we look at portfolios on Interactive Brokers that we link our clients to, we have 3 portfolios set up using these algorithms: conservative, balanced, and aggressive. In conservative, we're just buying. I wouldn't rule out anything, but I would say on a grand scale, most of the time we're just focused on that bottom tier. We're just buying the indexes. And we get outperformance by being in cash when the market's going down and by focusing on the right indexes, those 5, to outperform the S&P. So we might be long the S&P, but we also have a piece of the Dow, the NASDAQ, small caps, and momentum, and they're all together going to outperform the S&P if the S&P runs. So that's how we get our alpha. So in our balanced approach, we're going to add the second tier. We're going to have our big cap in our index positions, and then we're going to add that second tier of group ETFs, right? Every now and then we own the stock in there. Every now and then we own the individual stock, but we focus on the first 2 tiers. And of course, the aggressive approach has all 3 tiers. And I guess what also makes it aggressive or balanced or conservative is the exposure to the market, right? How much exposure do we have? How much exposure to volatility do we have? We're going to have the biggest exposure in our aggressive approach, obviously, and our least amount of exposure in our conservative. And in a down market, we're going to have short positions in our aggressive portfolio, but we're going to hold 100% cash in our conservative, right? So you guys get the idea. All right, so I'll talk to you tomorrow at 12 o'clock, let you know if there's any group ETFs that are fitting the bill that make me more confident that this rally has legs and gets us to broaden out our approach. We do own individual stocks right now. As I mentioned earlier in the show, Microsoft, Illumina. So what we look for there, we look for stocks that are on our whiteboard that we like a lot fundamentally, that are in technical positions where their 200-day moving average is still in an uptrend. So right now, most of the moving averages on the big indexes are in downtrends, which is bad news. But that also helps you find the leaders. Microsoft, Illumina, and a couple other names I can't really mention because they're smaller cap in nature, and I'm still accumulating some of them. So what I would say is we look for names on our whiteboard, fundamental names we like, where the 50 and the 200-day, or at least the 200-day, are in uptrends, and we get a double bottom with a risk-on signal. So we've got some of those positions in the portfolio now, and we might get some more by the end of the day. So we might be adding a couple more individual names to the portfolio as well. So I guess that's all for today. Tune in tomorrow. It's going to be a very important day. We have to see how this market closes today, and then we'll know how much risk exposure we're going to carry for the rest of this ride. And just to be clear, on our desk, with my own personal capital and that of individuals that we manage capital for through these 3 linking portfolios at Interactive Brokers, we're going to be fully committed. Whatever that full commitment is, it's going to be committed by the end of today. Maybe we sprinkle a little tomorrow on weakness in the morning if we get it. And then that's it. We're done. We've got our exposure and we let it run. And what we're doing is selling on the rally. Oh, thank you, Blog Talk. We're selling into the rally while everybody else is reaching to buy over the next couple of weeks. We'll be feeding out to them. It's lots of fun to invest like this, guys. Join us. Start getting used to these millennial tools. They're going to help you. 90% of all trades, don't forget this, 90% of all trades on the major averages are executed by algorithms.
60 seconds.
If you're not using algorithms too, you're at a distinct disadvantage. It's like bringing a knife to a gunfight. It's not going to end well for you. I had to learn that the hard way. I've been doing this 30 years. The last 6 years, we've been developing computerized algorithmic trading opportunities to help us manage our risk. And that's what I'm sharing with you. Listen, guys, thanks so much for spending time with me today. Thanks for watching. Thanks for listening. It really helps me, believe it or not, maybe more than it even helps you. It keeps me honest and it makes me execute every day the way our ARMR report is telling us to execute. And performance follows. Have a great day trading. Be safe out there, and I'll talk to you tomorrow.